Amy, earnings season seems like it's off to an okay start. What kind of activity are you seeing beneath the surface?
Look, beneath the surface, I think the most important thing we've seen is that consistently option moves have been beaten. So the implied move that we have going into earnings pretty much gets blown out of the water. And you can see that in terms of what happened with Netflix. And this is exactly what happened last earnings season. And it's also happening with Tesla now, which went in with about a 4.5% earnings implied move this weekend. And now I think is up about 8% the last I checked.
Okay, well, that kind of answers my next question, Amy. You just referenced a stock that I suppose surprised on the upside. I was going to ask if this was more relevant on the downside, but maybe I'm just too focused on what we heard from Netflix. Do you see any divergence there? Are stocks that disappoint moving more than stocks that beat estimates?
Yeah, actually, I do. So, one thing that we saw last earnings season, which was very different than historical earnings seasons, is every single tech name that essentially didn't do well during earnings, think Facebook or whatnot, every single one completely beat their implied move on earnings to the downside. And that wasn't true on the upside. So, Tesla is an example of where there was a beat, but actually it's mostly been on the downside where we see that divergence, where essentially if they go down, they really go down. And I would actually point to Facebook because Facebook's been interesting. Our research analyst has been saying, despite its underperformance, that this is a name where on this quarter we could still see further positioning to the downside. That's not currently being reflected in the options market or in skew, but is one to watch because of what happened last quarter and because those implied moves to the downside, even when they look kind of expensive, still end up beating on earnings day.
Amy, of course, we need to talk about some of the people that get caught out and hung out to dry, essentially, when these stocks do go down as dramatically as they did with Netflix yesterday. Retail traders have been so active in this market for so long. Liquidity has been abundant. They had stimulus checks to spend. That is a story that is now changing. What happens if that retail activity wanes?
Yeah, I think that's a really interesting observation because one thing we've been talking about in terms of flows is it's been a very bifurcated equity market. So you have, on one hand, really strong retail buying, not only of stocks, but of calls. And you also have strong corporate buybacks. Whereas on the other side, we see a lot more institutional risk reduction, institutional hedging. If you take one of those legs out, essentially, if you take retail out, what does that mean to the direction of the overall market? But it's really surprised me how resilient retail has been. So, for instance, this past week, we've definitely seen retail demand waning. But I can tell you that on Netflix, after it's gone down, we've actually seen some retail stepping back in. And
Interesting.
I think, yeah, and this is without the accommodation of the Fed or of stimulus. It's almost as if a large part of the retail market has just woken up to the fact that the stock market exists and it's easy to own and it's easy to own options, and that fact remains.
Amy, do we see retail investors, sticking with that theme, do we see retail investors bringing stability or volatility to these maybe individual equity names, if not the whole market, or is it too complex to say?
It's probably a little too complex to say, but I would lean towards saying that it's going to increase volatility. One, because there is no, it's very stock dependent, and you really don't know when they're going to step in, and when they do, it often is a surprise. But two, it also depends on how they lean into the market, and oftentimes they always lean onto the upside, which can cause exacerbation and some swings to the upside, which is dissimilar to the institutional world, where oftentimes it's much more of a hedging demand.